It's a great pleasure. It's been a very interesting day today, and there's so much, of course, to learn from so many different people with different perspectives. What I'd like to start with is a little story. Do you know Raspberry Pi? Now, they're quite an interesting firm because they promised, I think it was maybe their investors or their customers, they went out and said, we're going to have this amazing new sort of cheap computer for everybody, and it's going to be $25. And they promised that they would be shipping by a certain date, sort of 12 months into the future. And that 11 months in, they hadn't managed to get their production ready. They just weren't going to be able to ship. But they decided we had to show that we have something for sale, because that's what they felt shipping meant. So they put one of their prototypes of their Raspberry Pi onto eBay. And it was meant to be $20, but of course it was $25 or $50. But it was a case of, eBay, of course, is an auction model. So they put it up for auction. And on the day they were meant to ship, they sold this product for $2,500. And actually, what is the value of the first ever Raspberry Pi now? $25,000? So I'm about to talk to you about building a crowdfund portfolio, investment portfolio is what I was asked to talk about. So I think the first thing to understand if you're looking at an investment portfolio is what is investment to you? And I think Eric talked earlier about things being 50%, passion and emotion, 50% wisdom when it comes to investing in things. The first thing to think about when you're building a portfolio is understand not only what you're buying, but why you're buying it. And if there's something where you're really passionate about the product, I promise you, as somebody who owns a business, can you buy my product? Whether it's crowdfunded or whatever, giving me customer sales. Customer sales are the best possible way to fund a business. So you're not somehow letting a company down if you don't invest in it in terms of equity or debt. There is an investment case for buying a product that gives you value either in the short term or the long term, both emotional and both real. So that's covered crowdsourcing. Thank you very much. Right, then we're going to debt. Debt's a really interesting area. The thing to understand about debt, I'm sure you understand what debt is. You lend somebody money and you get money back. But what matters is pricing the risk. And what we have to understand in today's market is how much, hands up, how much do you get in the bank if you leave your money on deposit in the bank? What? 1%, 0.5%, 0.17%, put it with the Bank of England, which you can't, of course, because you're the general public, but where you're able to 0.5% LIBOR. So that is the risk-free rate, basically, and let's not worry too much about the details of inflation and other things. So if you're going to buy a loan or lend money to a company, and they're saying they're going to charge you 2, 3, 4, 5, 6, 7, 8, 10, 16%, understand that that is about increased risk. And with increased risk comes the excitement that you might be making a lot more money than you get from the Bank of England, but it also increases the chance that that won't repay at some point. So again, when you're looking at that, debt is an asset class. You have to think about it like bonds. Some angels I was with the other day, there was a bond peer-to-peer platform, and they said, introduce me to your rich angel friends so they can invest in our lovely bond products. And I brought in a load of angels, and they said, bonds, that's boring. We don't invest in bonds. Our fund manager, wealth manager, he invests in bonds on our behalf because that's really dull. Go and see them. And I promise you, they look really hard at risk and the pricing of the risk. So do remember, if you're going to invest in debt, to understand that if you're buying a bond at, say, 16%, that's, in very simple mathematical terms, 32 times more risky than leaving it with the Bank of England. So again, I'm a big believer in it. You must treat it seriously, particularly if you expect a return, and understand the risk you're taking. Understand things like what happens if something doesn't repay? Where are the guarantees? And if you don't care if you don't get your money back, that's fine, but do be aware of understanding that. And then we go into, of course, the bigger area, which, of course, is much more important which is investment. And so I'd just like to know, if you take a sort of whole load of companies, how many, does anyone have any rules of how many will succeed out of how many you invest? Anyone have any anecdotes of, if I invest in X, X many will succeed? Yeah. Okay, so that's for 1 in 20, or 19 in 20 to fail. Yeah. So there's that sort of number. Something often talked about is people say 1 in 10, surely 1 in 10 will make me loads of money. Well, actually, the only stats we really have is a report from something called Siding with Angels, which was done in the US and the UK, And what they showed actually was that 3 in 30 give you gangbuster returns. So think about that, because if you only choose 10, but you actually sort of need to choose 30, and if you remember that the super cool people are probably finding the super cool investors, so maybe you're not getting access to some of those, statistically, which is why data matters, you probably need to find 30 investments to make sure you have a diversified portfolio. And to support that, if you go and see your average wealth manager as a wealthy person and say, I just want to buy FTSE 100 companies directly, they will say that you're properly diversified in the FTSE 100 if you buy 15. So the idea in the crowd, which is earlier stage, more risky, etc., that you can do 2 or 3 and be guaranteed to make loads of money, it's simply statistically unlikely. Now, you may get lucky. I know angels who've done 2 or 3 and made money on everything. So you may have better judgment, and we'll talk a bit about that in a second. The other thing to think about is that overall, over half of deals will probably fail. That's probably a fairly safe assumption. So remember, when you're investing, to the most cautious investors I know, they write all their investments down to 0 the minute they've invested. So they invest, and then they say, I'm going to assume I've lost my money today, so everything from now on is going to be upside. But statistically, over half are likely to give you less than your money back or 0 back. When it comes to tax breaks, remember that it is really important, if you're investing under EIS or SEIS, actually to fill in the forms for the taxman and make sure you make your claim for the money. Because there's no point in saying, oh, I've invested under SEIS, I've got 50% of my money back, but you actually haven't because you've not bothered to do the paperwork. So again, think about that, because that really matters. So those are the broad frameworks to think about. When it comes to building a sort of data-based or data-driven investment portfolio, there are various things to think about. One is that there aren't always facts, but even the fact there isn't a fact is a fact, if you see what I mean. So you can always find information that will help you form a view and an opinion. And whether your view is based on emotion or judgment or wisdom, there's always something behind that that leads you, drives you towards that sort of response and how you're going to behave. So do think about what is driving you, but also think what facts support your emotions and your judgment and your wisdom to make you able to make an investment decision. And of course, the best thing of all is nice, hard facts, which you believe mean that an investment will succeed. So I talked earlier, some of you were here earlier, we talked a bit about management. You know, I believe that if you've had more experience, I think Eric's explained your experience of when it goes wrong, boy, you learn much more when it's gone wrong than when it's going right, don't you? And that makes you a more experienced person. I believe that is worth more than someone who's not been through that journey. So actually, I don't mind failure. Now, some other investors will say, well, if you failed in the past, actually you don't care about failing, so that's going to be a negative. So I don't know whether half the third who will agree with which position, but at the end of the day, you have to decide which position you want to take, and then base that knowledge and apply it when you're looking at new deals. When you look at management teams, one of the interesting things when we do ratings is that experienced people, experienced entrepreneurs, when we ring up and say, well, we could do this rating, there's no charge, you know, the worst is you don't like it and we won't publish it, so you've learned a bit and whatever. What's interesting is that there is one clear line, which is people who are more experienced tend to say, well, we'll give it a go because we're curious and there's no financial cost to us, so it's a bit of time, but you know, we'll learn something, and if it comes out good, it might be to our advantage. And people who are inexperienced entrepreneurs, who've hardly ever, maybe in their first ever entrepreneurial journey, you tend to go, what do you mean you want to like challenge what I think or what I say? You want to have an opinion? No, of course you can't. So again, have a think about, you know, the types of people, and sometimes the data you need is not hard facts on years of experience. It might be on attitude. You might say, I like entrepreneurs who have a positive attitude, or who, you know, never believe in this, or always want to start in their local market, or never want to start in their local market, only want to go to a really underdeveloped market. Those are actually, that's data, and that's facts, that's information which will help you decide what to invest in and what not. When it comes to products, it's really interesting. Products, you know, if you just like the product, don't be fooled into investing in the business if you don't really believe in the investment proposition. I'm trying to think what business is. Ice cream, I really like ice cream, but I don't know if I'd buy an ice cream company because it's, you know, incredibly variable as the year goes by. Unless, of course, it's a global company and can sell ice cream when it's hot in different parts of the world. I don't know. I'm just giving you an example of how to think about when you're making an investment decision when it comes to product. The crowd, the stats we've done, we did some research earlier this year, and what we discovered, interestingly, is the crowd is really good at spotting a bad product and avoiding it. Actually, they're also really good at spotting a really great team, but they're not so good at avoiding bad teams. So that's interesting. So then, and I'm sure you can imagine the sorts of facts around products. There's things like market share. Competition is something to really think about. So often I'll see a little company and it's got the brand new whatever payment system, and then they put their competitor analysis and they forget to put PayPal on the slide. You know, so do apply common sense. What do you know? Do ask around. Don't just think, oh, because they say it's the new thing. It's not that they're lying to you. They may just not know. It'd be a bit surprising if they didn't in that context. But you know, do think, do your own research and challenge what people say. Because in my view, most people are terrible. They're really honest and they want to tell you their thing, but they also are trying to get cash out of you in return for shares. And so that's what they do. So when it comes to financials, what you want to do is think quite hard. Now, there's a really interesting debate. Some people say all financial forecasts are a load of rubbish. The only thing you can guarantee is they won't be what they say in the numbers. But the big thing is financials tell you about the ambitions of the company. So we see companies, my favourite set of financial projections ever is 20,000 turnover this year, 63 million turnover in 5 years' time. Has anyone tried to actually, do you know how much trading you have to do to get to 63 million turnover and what the work involved in that growth? Just to get that headline, let alone make a profit and actually have someone buy your company. And what really scares me when I see projections is when they're not only on 63 million turnover, but they've also got 50 million pounds cash in the bank in year 5. Now, anyone who's run a business knows that if you're on that sort of growth curve, you're certainly not leaving the cash in the bank. And if you are, you should be paying out as a dividend. You know, if you've really got no better use for it, you're chucking off so much cash, you can't possibly think of anything else better to spend it on, you should give it back to your investors. So have a think about the sorts of things in the financials, what the financials are telling you, not just the raw numbers, but little things like, is the gross margin for a company in that sector? I'm going to use brewing because there's been so many brewing campaigns, so there is the stats there. Is the gross margin for the latest brewing campaign for that company, is it in line with the rest of the market for other companies who do brewing? Are they at 60% gross margin versus 40? So if they are, it's not that they're wrong, but get them to justify it, or you have a think about it and say, is it right? I'm on 0 points now, 0 seconds. So I think I've probably covered in summary the key things. But do remember that there are about 2,500, 3,000 quoted companies in the UK, is that including AIM? And there's 4 million SMEs. So do remember that the exit is not as easy as trade sale or IPO. Remember that statistically, most investments take 7 to 10 years before you get what's called the liquidity event. And a liquidity event is not the same as an exit. A liquidity event is you getting a check for cash for your investment. So that doesn't always happen via, it's quite statistically unlikely to happen via IPO. Much more likely to happen by trade sale. Quite likely to happen because the management actually buy your shares back, or another investor decides to buy your shares, though that's not a terribly developed concept. So remember that when you're investing, you've got to look at, say, getting 30 deals, or finding just 1 or 2 you know really well. You've got to really look at the financials and understand what they are telling you about the aspirations of the business. You've got to understand the timescales. And last but not least, there's an old rule in angel investing, which I think applies to the crowd, which is that the chances of somebody coming back to you for more money, once you've invested in them once, is very, very high. In fact, they might come back 1, 2, 3, 4, 5, 10 times. I think DHL did 15 rounds, and the only people who actually made a good return were the last investors in before the flotation or whatever. So remember that you are buying a seat at the table with the early rounds often, not getting necessarily a positive return. And remember that to keep back, for every pound you invest, keep back at least £1, if not 2 or 3 or 4, to reinvest in follow-on rounds, assuming you really love the company.